Good morning, this is Wayne Belisle with a Smart Profit Maximizing Moment. Today we're going to talk about 26 year-end tips, tax savings tips for families. Everybody, individuals, I say families, but individuals. Everybody who has to file a tax return, which is 160 million of us. Oh, all right. Tessie's giving me a look like, hey, you didn't pick me up. This is Tessie. She's our office dog at the moment. All right, here. Sit down and be quiet if you can. Anyways, like I said, my name is Wayne Belisle. Let me get so we don't see background. People are moving. I don't want to distract people. My name is Wayne Belisle, founder of a local CPA firm. We do three things basically. We help our clients make more money, which is the reason for these videos. Even if you're not a client, there's plenty of tax savings and profit increasing tips. We help them save taxes. That's seriously what we're in the middle of doing. In about 50 minutes, I have an appointment with a doctor to help them save some money. And we obviously file tax returns. Look, when I'm recording this, it's like November 12th. Yesterday was Veterans Day. You have less than 2 months before the end of the year. Hard to believe. Amazing that 2019 has gone that fast, isn't it? But anyways, that's neither here nor there. This is prime tax planning time. In the last 3 years alone, we've saved over $4.4 million for our clients legally. And we used a lot of these tips. We talked about business savings last week sometime. You can find it on my blog. Getting to my blog is easy. Go to my website, wjb-cpa.com. Some tabs on the top. There's one that says blog. Click on it. You'll find that article and the video. Okay, I usually post both on the blog, the video and the article. Let's take a look at what they are. I mean, look, it's limited if you're just a wage earner. There's limited things you can do. The IRS has been pounding to get rid of a bunch of deductions for the average wage owner since the late 70s, to be honest about it. And they did a really good job in 2017 with the Trump Tax Act, basically increasing the standard deduction. And it probably wiped out itemized deductions for 85-90% of people. But anyways, there's still some things you can do. Biggest one and easiest one is maximize your 401k contribution. It's one of the best things you can do. Plus, most of these plans, the employer matches. So look at that. Maximize the credit for the first 4 years of college for your kids. The American Opportunity Credit reduces your tax by up to $2,500, of which $1,000 can be deductible. Can be refundable is what I meant to say. If your student just started this fall, consider paying the spring tuition in December to maximize the deduction. In low-income years, consider converting your regular IRA to a Roth IRA for very little tax costs. Future distributions from Roths are non-deductible, non-includable in income. Under the new law, remember, you can't reverse this once you do it. If you itemize, which is rare, clean out your closets, your garage, whatever, and donate them. Get a receipt. Highly recommend taking pictures. An alternative to donating household goods is a yard sale. Since items are usually sold below your cost, it's usually tax-free. You can't deduct the loss. If you itemize prepaid medical expenses by December 31st, if you have a lot of medical expenses, try to get them all in 1 year by using a credit card. And that way you can deduct it in the year you charged it. Track your medical and contribution mileage, all right? It's worth some money for you. If you're still filing short of the itemization deduction, consider bunching it in 1 year or the other, what you can do. Put medical contributions, medical payments, contributions, and property taxes double up in 1 year, so you itemize 1 year, standard deduction in the next, all right? If you're thinking about buying a car in early 2020, buy it in 2019. If you're able to itemize. If you're not able to itemize, pointless, don't bother. Get a home equity loan, pay off personal loans. You can deduct up to $100,000 of an equity loan regardless of how you use the borrowed funds. If you have losses on your stocks and mutual funds, you should consider selling stock investments that have a large unrealized gain to offset them, because remember, you can only deduct up to $3,000 of capital losses. Be careful of wash sales. Get with your tax advisor. As long as it makes financial sense and fits your financial goals, sell any stocks in a loss position to offset any capital gains you may have. The reverse of what I just said. You sold something for a gain, or your mutual funds are selling at a gain, review them before year end and see if you have any loss positions. Again, watch out for wash sales, which means you can't replace the stock within 30 days. Get with a tax advisor. If you're kicking out a bunch of interest income and dividends, consider municipal bonds. They're tax-free from federal, state, and local taxes for most people. If you're in Texas, you don't need to worry about the last two. If you have taxable income from investments that you're not going to use to live on for a number of years, consider investing in an annuity or a life insurance where the income is not taxed currently. Pay down your outstanding student loans. You can deduct up to $2,500. If you're getting hit with the alternative minimum tax, then get with a tax advisor, look into ways to reduce that if you can. All right. Audit proof your deductions. The IRS follows a very simple rule. If it isn't written down, it didn't happen. If you don't be afraid to take deductions as long as you have documentation. So make sure you document it. Simple as that. If you or your siblings pay for more than 50% of a parent's support, but none of you pay 50% by yourself, you can easily claim the deduction. All right. There's a way to do that. I lost my place. Yeah, there we go. One of you can claim the deduction by, making that election. And if you're single, that can make a big difference because now you can qualify for head of household. Consider a health savings account, an HSA. If your employer offers one, contribute the maximum, $3,500 for individuals, $7,000 for families. If they don't offer one, see if you can set one up yourself. 21, rent out a portion of your personal residence or second home for fewer than 15 days, and you don't have to report the income. I don't know how you would do this. Maybe there's a way for you to pull this off if you work at home, rent it to somebody, get with a tax advisor and explore possibilities. Deduct alimony payments if they're before 2018. Okay, after 2019 actually. After 2019, you can't do that anymore. So hope you got divorced earlier if you're going to get divorced. I hope you never get divorced. Bad move, bad statement. But if you do, get with a tax advisor. 23, make sure your home equity loans are deductible. The new tax law completely changed the game and makes this tricky, so get with a tax advisor. 24, be careful of the 3.8% surtax on unearned income. If you have unearned income and your adjusted gross income is over $250 for joint filers, $125 married filing separate, and $200,000 for others, you better see your tax planner and see if there's a way to avoid that extra 3.8% Obama tax. Came about because of Obamacare in 2010. Consider arranging with your employer to defer until early 2020 any bonuses you may earn if they would push you into a higher tax bracket. Remember, tax planning looks at both years, 19 and 20. So you need to figure out where your income is going to be. If your income is going to be higher in 2020, take the bonus in 19. If your income is going to be the same or lower in 2020, defer it. Finally, if you're older than 70 and a half and required to take a minimum distribution from your IRA and you don't need the money, consider making any planned charitable donations directly from your IRA rather than your personal funds. This prevents the donations from being added to your income from the higher standard deduction. Let me try that again. That came out wrong. If you're not able to itemize, which many retirees can't because their house is paid off, so the donation is not going to be deductible anyways. What you're basically doing is instead of taking the money out of the IRA, which is taxed to you, and then make a donation which you can't deduct, you just take it out of the IRA and you don't have to pick it up as income. This is the main ones for individuals, not as sexy and not as easy. You're not going to save a lot here, but every little bit helps. Anything you put in your pocket doesn't get sent to the IRS. If you have a business, make sure you go back and watch the last one. And the next one we're going to do is for anybody who has real estate. Very key. Watch that one. Hey, until next time, this is Wayne Blau saying, pay as little taxes as you're allowed to by law, and let's make this our most profitable year ever. Thank you very much.